rather than little on little squares on the laptop. We've got in our midst Emma Price, who's the new pensioner rep for the committee. Yeah. And I'll hand over to Roger to introduce everybody.
Just to say, Emma, you're most welcome. So you were telling me before you've just started on the Hyman's training program. So I'm hoping you're going to enjoy that, as indeed we all should be doing. So just to put that little reminder out there for everybody. Thank you.
Also from ELSA, we've got Cameron here and attending today, so welcome and thank you for coming along. Do we have any apologies for absence? We've got everyone there. The minutes of the last meeting held in the part 1, are they correct? Yes, agreed. Good. The quarterly fund performance review, I'll hand over to Roger to go through that.
Okay, thank you very much, Chair. Just briefly, the performance for the last quarter here, this is to the period ending September 21. The fund returned an increased value of some 6.8 million, which takes it up to the 932.9 million mark. We're nearly at $1 billion, but we live in hope, but I'm sure we'll get there sooner rather than later. So in essence, total funds, though, total fund assets returned some 0.5% compared to the target of 0.7%. Members will recall we've been overweight in equities for some time now, and this is probably the last report you'll see where that overweight has been present, because we have recently moved about 100 million of the fund in accordance with the decisions of the committee to the diversified growth fund within the London Civ, some going to Bailey Gifford, some going to Ruffer. And so we're starting to rebalance the fund and that overweight position in equities. And we've got another 40 million that will move the final tranche probably around about early December. And so, as I've reported on a fairly regular basis, we've tended to do very well by being overweight in equities, but it wasn't a sustainable position from the fund's point of view because it wasn't in line with our agreed strategy. So, it was with a degree of a heavy heart we've had to rebalance, but we wanted to secure and lock in the gains that we've made on equity. So we've greatly benefited from that. I think the only other thing I would say, it's worth noting that the 3-year annualized performance for the fund is currently 9.9%, which is against the actuarial performance target of some 4.8%. So we've done very well as a fund over the last 3 years. And as you will see later in the agenda, we are approaching our triennial valuation next year. So that bodes well for that. Obviously, it also depends on how our liabilities have gone, but certainly our assets have delivered in a very positive way over that period. I'll leave it there in this public meeting, Chair. If there's any questions from that point of view.
Right, does anybody have any questions? Omar.
Thank you, Chair. It's Adam, actually. That's fine. I've been called far west. A question to Roger. With obviously the anticipated asset base going up, has that been reflected in the annual updates with the valuation? So are we looking to be sort of trajectorying into a continuous surplus?
I'm sure Barry will cover that in his presentation later on, Councillor. But yeah, I mean, it's on the positive side. With any revaluation, you have to look at both aspects, both the assets and the liabilities. And obviously the liabilities are affected by all the demographics and all the things that actuaries take into account, which fortunately tonight we're going to find out all about and their approach to that. But from the assets point of view, yes, we're sort of pretty much double the expected assumptions that the actuaries made, which is a very positive position to be in, but you have to take both sides.
Any more questions? No? Okay. We'll go to the next question is the March 2022 triennial valuation by Barry McKay.
Okay, thanks, Chair. Hopefully everyone has this in front of them. Yep. So I will jump on to, I don't know what page it'll be in your pack. I don't have your pack, unfortunately, but it's basically an agenda slide. So what we're going to cover, sorry if this is old news to some of you who have already been here for a while, but we're going to look at how we value the liabilities, why we do the valuation, first of all, how we value the liabilities, which Roger's alluded to, and that it's a bit different from, we all know how the assets are done, but the liabilities are a bit more of an estimate. How we value the assets, which is relatively straightforward, and how that impacts and how we set contribution rates. And then just the last part about what's other things, other topical issues we need to be aware of for the valuation. So if I can jump on to my slide 4, which is looking back to your last funding valuation, that's the title. And this is just a recap of where we were at 2019. So the fund was in a very healthy position, funding level of 103%. So that means that the funding level is a ratio of the assets you're holding over the value of the liabilities. So in other words, you'd slightly more assets at 718 million relative to the value that we as the fund actually placed on the liabilities of just under 700 million. So a 20 million pounds surplus. So that was really good news. That allowed us to set contribution rates of around 17.5%. We'll come on to this in a bit more detail later, but the contribution rate is effectively made up of two parts. What we now call the primary rate, which is the cost of the benefits that are going to accrue in the future. So it's all about the active members who are still accruing benefits over future years, and the past service, or what we now call the secondary contribution rate, so that you make an adjustment to the contribution rate depending on whether the fund has a surplus or a deficit, and you spread that over a period of time. So because the fund had a £20 million surplus, we could reduce the contribution rate. So back at 2019, the rate was 17.5% of pay. So a very good result. There's also the Government Actuary Department carry out a valuation as well. I'm laughing because we still haven't officially seen the report, which is now almost 2 years ago, 2.5 years ago, and we haven't got the report from the Government Actuary Department. But they did give a summary for each fund, and your funding level and their sets of assumptions was 110%. But the most important thing was they look at various financial metrics in terms of cost efficiency and solvency, and you get green flags throughout. Your fund get green flags throughout, so that's a good thing. If you're flagged with an amber or red flag, then you have to effectively get summoned to the headmaster's office to explain yourself. You get green flags, so you were fine, and I'm sure you'll be fine again at the next valuation, which we're going to talk about now, because the next valuation date is 31st March 2022, so not that far away. And we've already started speaking to the fund's officers about that, and had our pre-valuation meeting. If we go on to the next slide, which is titled "What is a funding valuation?" number 5 in my pack. This just sets out what we do. So we have to, very high level, what we do. We have to we value every single member in the fund, and we value their benefits. And unfortunately, the way we have to do that is make lots of educated guesses about what's going to happen over the long term, because your fund is hopefully a very long-term scheme. And so we project things like inflation and investment returns and salary increases and life expectancy over the long term. So it's a bit of a, as I say, an educated guess at the time, and that's why we come back every 3 years to update that and make sure we're still on track. The two key elements of the valuation are to check that you've got enough money in the fund to pay all the benefits that have accrued to that point in time. And if you haven't, to make up that gap over an appropriate period of time. And then the second thing is to set the contributions for the next 3 years for every employer in the fund. And every employer has their own contribution rate according to their own membership and circumstances and so on. So they're the two key results or key outputs from the valuation, but it takes quite a lot of work to get to that point. And so the valuation that kicks off on 31st March 2022 will take most of next year to complete, but we'll come on to the timetable shortly. Okay, if I go on to the next slide, which is about the setting contribution rates for employers. There's various, I've already talked about a couple of these boxes. We've got the funding strategy, the primary rate and the secondary rate. I've already talked about the primary rate and the secondary rate. The funding strategy is effectively the framework that the fund sets out, and we need to carry out the valuation in line with that framework. And it will detail the assumptions we adopt, how employers are treated, that we have on if the new employers come in or on exit and so on. And that's kind of the Bible, if you like, of how we have to perform the valuation next year. As I say, I've already talked about the employer contribution rates in terms of primary and secondary. We will come back to that later. So if we just have a quick look at the timetable, so you know roughly how this goes, and it does take quite a while to complete the valuation. The first stage is to get the data in, which we'll probably get by the time all the employers provide renewal data. We'll get that next summer, usually sort of May, June time. Merton are one of the funds your fund's one of the early, you get results usually very quickly. Your data is very good, I should say, and it means we can then process the calculations very quickly. And I think last time I remember meeting Roger and Namashi and others, and on the 4th of September, I think it was, and we had results ready by then. So it should be the same again, should be even more efficient this time. So we should manage those sorts of timescales, and then that provides the whole fund result. And then we go agree the assumptions at that point and go back and start going through all the individual employer results. And then we issue those results to employers in sort of October, November time. And the whole process has to be wrapped up by the following March. So plenty of time for your fund, given we managed to do the majority of it so early on in the process. And then everything's signed off in a final report and a final, what we call a rates and adjustment certificate, which sets out the employer contributions for each employer in the fund. I'll just happy to take questions, but I'll keep going until someone asks me something. If we move on to section 2.
Adam, do you want to have a question?
Yeah. Apologies, Barry, if I have asking it a bit earlier, but in terms of because obviously your valuation then turns into a certification of a contributions or something. Well, a recovery plan. How is the recovery plan sort of, because I know in previous years, the aim was to shorten up that recovery plan in comparison to other councils. Is that still the plan for this valuation? And given the sort of future around sort of funding around local councils and etc. And from COVID, is it wise to maybe extend it this year?
So it's a good question, and there's several points to make on that. The first point is that Merton has one of the lowest recovery periods in the LGPS. I think it was about 12 years for the council last time. The second point is that it's likely you'll be in surplus again, possibly even more surplus. So by shortening that, you're actually being less prudent, because you're then spreading a surplus over a shorter period of time, so you're getting more money back quicker, if you like. So in some ways, you probably don't want to shorten it. And I would argue that for an open scheme like yours, you don't really want to go much lower than 12 years, because what happens is you start getting more volatile contributions, because the minute if you jump a bit above 100, drop a bit below 100, and you're spreading that over a short period of time, the contributions jump around more. So the other point in that is the future working lifetime of, so that the average time that active members have got till retirement is usually at least 12 years. So that feels about right. So I wouldn't reduce it much from there.
Yeah, thank you. So because obviously my understanding is that when obviously a scheme gets to 100%, there is either a decision to continue at that surplus, i.e. get no deficit funding contributions from the employer, say the council here, or one is if there is any, I don't know, surplus reserves Caroline's got tucked away somewhere, that could be used to still make the payments. So over time, the funding level is going higher and higher and higher. I don't know whether there is any sort of end game with a council pension scheme as a private sector pension scheme in respect to buyout or buy-in or anything. I'm not sure about that.
Yeah, okay. So I'll answer the second part first. There is no, you're not, under the regulations, you're not allowed to buy out. So there's no end point for someone like the council that's open, an open employer in the fund. We need to be careful. This 100% is a bit of a mythical number, a percentage, in that if we're 100% funded today, we won't be tomorrow. It'll have moved again to something else. And so actually, you don't really want to, I don't think you want to be 100% funded. You want to have a bit of a buffer, and we were just speaking about that earlier. So I agree that even if you're over 100% funded, you might want to keep contributions as they currently are to try and protect that surplus that you've got. Because as we saw, March 2020, a year and a half ago, when markets plummeted, now sure they bounce back, but next time they might not, and therefore you want a bit of a cushion for events like that.
Thank you. And I think that's part of the discussions, depending on what the final results are, that we will look at what the options are. Because certainly last time, although we then went into a surplus, our contribution rates going forward went up. So we had the interesting challenge of, going out to services and saying we need to increase the budgets and increase costs, and yet we were 103% funded. So that's part of the challenge that we have. We also need to be careful, because I think one time where we kept our recovery rate the same, we got amber flagged in the Section 13 GAD report. So that's all those sorts of things to play into what we need, but also clearly the financial stability of the council and the pension fund we need to balance off. So that's certainly something that I'll be looking at when it gets to sort of next summer or late summer, when we get the information through, to see what the options are, what it means. And if I need to find even more money for additional employer contributions, we'll need to see what impact that does have.
One of the key objectives we have at the valuation is to keep contribution rates as stable as possible. And given the returns, that the asset returns, investment returns that the funds achieved. I think that'll be fairly straightforward this time, but notwithstanding, we'll have those chats next September, I'm sure, depending what you need, money for other things. Okay, on section 2, this section is all about how we value the liabilities. I can skip over slide 9 in the interest of time, which is the one that just has a few boxes about how we do it in terms of the data comes in and we make some assumptions and we run the calculations. There's nothing terribly interesting in that, but it starts to get a bit more interesting once we start talking about the key actuarial assumptions. These have a huge impact on the value we place on the liabilities, and that's because of the fact that the scheme is very long term. So you get the effect of compound interest here, or compound inflation, or whatever it might be we're talking about. And so a very small change in some of these financial assumptions can make a very big change to the value we place on the liabilities. And the key financial assumptions are shown on my page 10, which is the pension increases, which almost all benefits now go up in line with CPI, consumer price inflation. And there's been lots of discussion about that in the news recently, whether it might spike up, or whether it is spiking up temporarily, and how long that might last. Salary increases, and there could be some pressure on that in the future. And what the actuaries call the discount rate, which is effectively our term for the investment return. So Roger mentioned at the start that the assets have achieved 9.9% per annum for the last 3 years, and we assumed 4.8% per annum. As you can see, there's a big gap there, but 3 years is not what we would measure it over. We're looking at what the return will be over the next 10, 20, 30 and beyond years. So the fund has done fantastically well, but that's not to say it can carry on produce 9.9% every time. And the second element is under the regulations, we need to be prudent. So if your investment advisors are saying the best estimate is, say, 5.5%, then 5.5% per annum, then we wouldn't use 5.5%. We would use something lower like we did last time on 4.8%, because we need to err on the side of the fund. But these assumptions the minute we make a change to them, they've got a huge impact on the liabilities. I think it was Einstein that said that compound interest is the greatest force in the universe, and he's right enough, because a small change of something like 0.5% on the discount rate or inflation will change your funding level by around 10%. So that's the kind of impact it has, and that's just because it compounds up over years. If we move on to the key assumption, discount rate is the heading of this slide, and the pie chart shows roughly what you were invested in. So you've got equities and property and infrastructure and diversified growth and all these things. And the way we come up with the discount rate at Barnett Waddingham is to look at the best estimate return on each asset class. And then we weight that depending on how much you're holding in each asset class, and that gives the total best estimate return. And as I said a second ago, we slice a bit off for prudence. So that's how we get to our discount rate. So it looks at what you're actually holding and your long-term strategic asset allocation. And then, as I say, we take a bit off to be prudent. So we wouldn't use the full best estimate. On the next slide, we've talked a little bit about this, the impact of changing assumptions. So the three main ones being CPI, salary increases, and discount rate. And the way this works is if obviously if CPI, if inflation goes up, then members' benefits will increase, and therefore the value of the liabilities will go up. And similarly with salary increases, if members get paid more, they'll accrue more benefit, and therefore the liabilities will increase for active members. The discount rate works in the opposite way. So the lower discount rate you have, the higher the value of liabilities. And that's sometimes quite a difficult concept to get your head around, but it's when you're paying for pensions, you can only really do it in two ways. You're either putting cash in or you're getting investment returns on your assets. So if the investment return comes down, the cash has to go up, and vice versa. So you're effectively saying if we're expecting a lower investment return in the future than we did 3 years ago, then you'll need to put more money in now to make up the balance. So a simple example would be if I need to pay Roger £100 in a year, and I think I can get 5%, I only need to hold £95 today. In a year's time, I'll have my £100 to pay him. Whereas if I only think I'm going to get 4%, I need to hold 96. So I need to hold a bit more money because I'm going to get a lower return on that cash to give him his £100. So it works the opposite way. Any questions on that? Or okay? Okay. I'll jump onto the demographic assumptions. The key one here being longevity, of course. So how long do people live? And there's been lots of stuff in the news about that recently. In the interest of time, I'll go into the more interesting chart, which is on page 14. How is mortality changing? And we've got a chart here that shows the trend over the last 20 years or so. And mortality was improving. It's been improving for decades, and it's roughly been improving 2 years per decade. So people have been living two years longer every 10 years. That trend started to tail off a little bit in about 2011. And that's if you've got the chart in front of you, that's the yellow line with the yellow dots. So it's not following the blue dashed line anymore. That's not to say, this is ignoring COVID at the moment, that's not to say people are living shorter time. They were still living longer, but the rate of improvement, the rate of increases was slowing down and beginning to plateau. And that's been since 2011. So we've had around 10 years of that anyway, but then COVID's come along and the red dot is where what happened in 2020. So a huge increase in the number of deaths. I still don't think this will have a big impact on the fund. And there's a couple of reasons for that. Sadly, those who have died from COVID have generally been much older. And therefore they would have had a smaller pension in general than those younger pensioners. And secondly, they would have less time to receive their pension. So clearly an 85-year-old would only be getting a pension for 5 years, say, as opposed to a 65-year-old would be getting it for 25 years. So in terms of the liability, it's quite a small impact. So we've been hearing about COVID constantly for a year and a half. Can't get away from it, but in pension fund terms, albeit very tragic, in pension fund terms, I don't think it'll have a huge impact on the past service position, the funding level. The bigger question is what we think might happen in the future because of COVID, or if we think things will come back to some sort of trend on the yellow line or the blue line, and we'll be doing work for the fund in the new year on that. Any questions on demographics? No. Okay, I've probably covered the next two charts, but just to give you a flavour for how huge this compound interest point is, if you can see this rump of cash, these are the benefits, the amount of benefit the fund has to pay out in each year. So we've got it's called first project cash flow is the title of the slide, and we've got active, deferred, and pensioner members, and we can see that it tails off after about 80 years. So in other words, a member joining today at the age of 18, 20 might still be getting a pension in 70, 80 years' time. So that's the sort of length of projections we're making. And those, if you added up all those cash flows, that's how much the fund will pay out. However, because of compound interest, if we go on to the next slide, and number 16, where we say we then discount to work out how much money we need today. So this is back to the idea of owing Roger £100 in a year. We only need £95 today. If we owed Roger £100 in 10 years, we'd only need about £40 today because we'd get 5% every year. So that big hump of cash flows reduces down to what you can see on slide 16. And very, very broadly, broad rule of thumb is it'll be about a quarter once you've discounted. So if we placed the value on liabilities last time was 700 million, it probably means you're going to pay out about 2.8 billion pounds over that period of time, but you only need 700 million now, and that these investment guys will do their job and grow those assets, and you'll pay the benefits each year over that period of time, so you'll have enough money. So it's a big deal. Okay. Just the last point on the liabilities. Roger mentioned this, how liabilities change over time. So on slide 17, we can see what impacts liabilities. We know how the assets change, but the liabilities go up in line with members accruing new benefit, the interest on those liabilities, and as we mentioned before, CPI pension increases. So pensioners and so on will get increases every year, and that increases the benefit. But you're paying pensions out, and as you do that, you're effectively getting rid of, you're paying down the liabilities. So that balances out some of the changes in the benefits. One of the big items, as always, on the right here is how we change the assumptions, if we change the assumptions, and that can have a big impact on the value of the liabilities we've talked about already. And those bubbles are kind of roughly the size of the impact it might make. So that's the liabilities. For us, that's the complicated part. The assets are a bit more straightforward. Every employer's got their own pot of assets. They've paid contributions in over the last 3 years. They've paid benefits out to their members, their pensioners and so on. And you've had investment returns on top of that. And therefore, at the end of the 3 years, each employer will have a different pot. And that's just what's shown on slide 18 when we talk about valuing the assets for each employer. So there's nothing more to it than that. It just works it out like a bank account, effectively. Fairly straightforward. Not belittling all the investment stuff that the guys do. That's a difficult part. But the mechanism of calculating the assets for each employer is straightforward. Okay, so the last main section is on employer contributions and just how we do that. And again, we've talked a little bit about this already. We calculate what we can now call the primary rates, the cost of benefits accruing over each year. We then calculate the funding level, the funding position for each employer, and that will give a deficit or a surplus. And then we'll spread that deficit or surplus over an appropriate period of time, which will vary by employer, because some employers are only in the fund for a few years. The council have the luxury of being in for forevermore, hopefully. So that recovery period does change. And then we get the total contributions by adding those together, and we certify those in the rates and adjustment certificate, as I mentioned earlier. So just lastly on the employer contribution rate is a slide here on slide 21, and what impacts the contribution rates. So we've talked about the primary and secondary rate. We also do work on covenant with some employers. So if you're a low risk employer, we'll be a little more flexible on contributions, and if you're high risk, we'll want the money in sooner. It's a bit like going for a loan or whatever. If you're higher risk, you'll pay a higher rate of interest because you might not pay it back, and we consider that for the fund as well. And so we can carry out some covenant assessments. We look at whether employers have got guarantees or some other bond in place, and that gives the fund reassurance that they'll get their money back effectively. And then we've already talked about the funding strategy statement and the fact that stability is one of the key objectives. So the last slide in number 23 is just wider issues, I guess. COVID being one of them, and we will go away and look at how we think mortality will change over time. Climate risk is another where we will have to work with the fund and investment advisors to maybe do some scenario analysis and so on to see how things might pan out. And I guess these guys might talk about that later. but there's also some liability, some issues on the liability side, which we'll look at. But we'll definitely have to do something. We need to say something in the valuation report and the funding strategy statement on climate risk. And then the most recent things, the inflation and where we think that might be both in the short term and long term, whether that could be an issue in terms of the cost to the scheme. And we'll be doing some modelling around that as well. So that will help us set the long-term inflation assumption, taking account of the fact we might see it spike up over the next, spike up in the short term. But I'm probably over time, so I'll stop there.
Does anybody have any questions?
Is that on? So there's been a bit of discussion of the discount rate being at 4.8% at the last valuation, and you mentioned that the best estimate return was above that, and you've lowered. Then you get to you sort of take an element of prudence to get down to 4.8. Have you got any sense of what prudence margin there might be at this coming valuation, and sort of how is that determined?
Yeah, so yeah, it's a good question. So we first of all, I guess we need to work with you guys to see what your best estimate is, and we've got our own investment guys, and we'll be good if we're on the same page. I think we did that in 2019 with JLT, was it then? So and we came to a sort of agreement of what best estimate was. We then run models so that we, you get a likelihood. We like to, as we said, we need to be prudent and weight it in the fund's favour. So best estimate by definition is 50-50. So you want something at least 2/3 kind of in favour of the fund. So we go back and run a model to gauge what that gap would be, and therefore that that informs the prudence allowance. I think, sorry from memory, I think it was about 0.7 last time, but yeah.
Okay, Nimashe, did you have a question?
Thank you, Chair. It's not a question, just a comment. Just for the information of the committee, last valuation, I think the pension administration did a good job with giving a good set of data, so that helped us to complete the valuation on time. And also for the employers, we didn't send out their results on the post or email. We are organized the employers open day, brought them in, and actually Barry was there, and so they were able to answer the question then and there. So that really helped us the last valuation, and we are continuing to do that again this year.
Okay, yeah. Right, then, thank you. So we'll go on to the next one, which is the pension fund update, the governance arrangements. Roger.
Thank you, Chair. Very briefly, it's really something I highlighted at the last meeting, is just simply to record the fact that the Pensions Committee is now a formal committee of the Council, whereas previously it was a panel, an advisory panel. And we thought it would be useful just to remind members of the terms of reference for both the Pension Committee and the board. Remember, we have we have two elements to reviewing the pension committee, the pensions affairs, Merton Pension Fund affairs. One is the committee, which is this, makes the decisions, etc. The other one is a board that sort of acts sort of as a pseudo scrutiny sort of panel for that purpose. But really, the only difference to highlight as a result of this new governance arrangement, which was approved by Council on the 7th of July, is that the committee is now a voting committee, and all that means is the three members attending the committee are the voting members, and the rest are advisory, non-voting members. Although I'm absolutely confident that the committee will continue in the same form as it used to, as a panel, very much on a consensus basis. But it's really just to formally note that there are only 3 voting members on the panel, whereas previously it was a panel, it was an advisory panel, but now it's a formal committee of the Council. So a bit of constitutional elements there, but it's important for the committee to note that. Thank you, Chair.
Marshy?
Thank you, Chair. Just give update on the training, what is going to come up for the next 4 quarters. And as you all know, the last meetings, we said there's online training that we make everybody enroll so that you can continue your own time. We'll try to match that training and coming needs. Like this time we had the actual evaluation, so it will be much more easier for you to go in that online training model now after listening to Barry. Same as next quarter, we will be looking at the investment strategy, because as part of the valuation, we will be reviewing the investment strategy. So we expect Hyman's to train on that. And you have a online training modules on that one. And as mentioned, there's another key part of the pension fund is the pension administration, which is managed by Wandsworth. So next meeting, they will be coming and talking at their part and how is it. And following that, obviously on the accounts is another important part. The March committee meeting, we compile the accounts, work with the auditors and produce the accounts as the annual report. So there will be a training on that one. It will be delivered by officers. And the following quarter, in the July to September quarter, we're expecting to look at the governance of the LGPS, because obviously there will be more development guidance on the scheme advisory board, pension regulator. So it will be a good time to update again. So this will come back every other meeting or something, keep you update what's coming up in the following quarters. That's it.
Yes. Nimashi, do we have anything, any audit update or employee?
Yeah, that one update, as most of you know, the main accounts plus the accounts, the pension fund accounts is not yet signed. The EY auditor are still working on that. So what is this means? We will not be able to publish our annual report by the due date 1st of December. It will be delayed. And also I'm pleased to say the auditors raised so many questions on the ISA 540, but they have now concluded they are testing on it and they're happy with that one.
Publish the report or?
Once they sign the main accounts plus the pension fund account, only we will be able to publish the annual report. Scheme advisory board did ask for a survey that I think, so we have notified them that we will not be able to publish the annual report. This is mainly due to the delay with the main council audit.
Chair, we're hoping to have that done before Christmas, but it all depends on our auditors on the non-pension work.
Thank you, Chair. So just to confirm, Nimeshi, the figures for the pension scheme are basically all complete. We're simply just waiting for the council side just to be done. Okay.
Right. The first part of the business is done, so we'll now close the public